Stop scrolling for a second because something just snapped in the metals market. And most people won't realize what it means until after the next move is already gone. Silver didn't just go up, it kicked the door into triple digits. And if you're not thinking 2 steps ahead right now, you're going to do the classic retail thing. Celebrate the breakout, then hand your gains back when the market plays its oldest trick. It's Wednesday, January 28th. Comment what time you're watching right now because I want to see where in the world this message is landing. Quick thing, I'm running a campaign to eliminate copycat channels. If you value the work I put in here, subscribe and comment Mr. Currency so I can spot the real ones. Now, before we even talk price targets, I want to start with something most market channels skip, but smart money doesn't: access. In May, there are 2 East Coast invitation-only conferences designed for serious investors and serious mining executives. The first runs May 17th through May 19th in Washington, D.C. The second runs May 20th through May 22nd in Fort Lauderdale, Florida, right on the ocean. 2 events back-to-back, separated by a short flight and structured for real conversations. And why does that matter? Because when markets go vertical, information gets loud, not clear. A booth conference is noise. A one-on-one slot with a CEO for 20 to 25 minutes is clarity. It's pointed questions, direct answers, and finding out what a company actually has, what it's spending, and what it's hiding behind glossy slides. That's why these events screen attendees. The whole model collapses if it turns into wandering tourists and free pen collectors. Keep that in the back of your mind. Because here's the uncomfortable truth. In a metal stampede, the biggest advantage isn't enthusiasm, it's positioning. And positioning is what separates the people who ride the wave from the people who drown under it. So let's talk about the headline everyone is screaming about. Silver touching $100 an ounce and pushing into triple digits. We're not talking about a cute intraday wick. We're talking about a psychological barrier that haunted this market for decades, finally breaking. The first question everyone asks is, did you expect it this soon? Here's my answer. I expected the move, but the speed still surprises me. Silver isn't supposed to behave like this. It usually teases you, punishes you, and then rewards you when you've already given up. This time, it's acting like a relentless buyer is sitting under every dip, refusing to let price breathe. That's not normal. As I'm recording this, silver is trading in the 110s after ripping past the century mark. That alone tells you we're not in a standard cycle. We're in a regime shift. And regime shifts are where fortunes are made and where careless people get wiped out. Now let me be very clear, because some of you only hear what you want to hear. I'm bullish, but I'm not blind. When you hit a major round number like 100, you don't go all in on greed, and you don't panic sell either. You trim, you manage, you stay in the game. Most people only know 2 buttons: buy and sell. Professionals use a 3rd button that isn't on the screen: scale. Scaling means treating a position like a thermostat, not a light switch. You adjust exposure based on conditions. If silver was 10% of your portfolio at $50 and it's now $115, that position may quietly be 20% or more without you doing anything. That's not conviction, that's drift. And drift is how good investors accidentally become gamblers. Trimming isn't betrayal, it's maintenance. A simple framework uses 3 layers. The core you don't touch unless the thesis breaks. The tactical layer you trim into euphoria and add on fear. The trade layer you can exit quickly if momentum turns ugly. Now, on indicators, I don't pretend any are magic. But I do watch momentum like RSI, volume confirmation, and most importantly, who is buying. Leveraged futures buyers unwind fast. Real demand absorbs dips. Right now, this feels much more like real demand, but I'm watching closely for when dip buyers stop showing up. The first warning is rarely a big red candle. It's a quiet day where the market tries to bounce and fails. That's when you tighten risk, not when panic is already trending. This is why you decide now what you'll do at 100, 110, 120. Write it down. Your future self will not be rational. Silver attracts believers, and belief is dangerous when it replaces discipline. If a position becomes so large that one bad week can change your life in the wrong direction, it's too big. So what do you do when price is at all-time highs? You don't pretend to have a crystal ball. You operate in probabilities. You trim in slices, not chunks, because trends can run longer than your ego can tolerate. Yes, near-term targets like 106, 107 make sense. And yes, into Q2 I can see 130-ish. But that's a map, not a guarantee. Silver's outperformance isn't just fear. It's utility. It's a monetary metal wearing an industrial mask. When money gets nervous and industry stays hungry, silver gets squeezed from both sides. Gold matters here too. While silver steals headlines, gold is rewriting expectations. Gold above 5,000 isn't the destination, it's the confirmation. Institutions are now openly discussing 5,400 and 6,000, and narrative drives flows. Gold doesn't need collapse to rise. It needs slow devaluation. And when governments notice gold going vertical, volatility follows. So ask yourself, are you a trader or an allocator? Most people pretend to be one while behaving like the other, and that mismatch is expensive. If gold and silver sell off after the Fed and snap back fast, that's absorption. If they can't bounce, that's your warning. The first move is often the trap. The second move is the truth. On miners, not all silver stocks are silver stocks. Some are dilution machines. Some are operational disasters. The edge is share structure, management behavior, jurisdiction, and cash discipline, not vibes. If you're not reading filings, you're not stock picking, you're gambling. Junior miners still haven't reclaimed prior cycle highs, which tells you how much runway may still exist if this persists. But baskets reduce blowups. Single names increase upside and risk. Critical minerals and PGMs are another quiet setup. When materials become strategic, rules change. Permitting changes, funding changes, acquisitions follow. These are policy trades, not buy and forget plays. So here's the real takeaway. This isn't about silver to 130 or gold to 6,000. It's about narrative, policy, and positioning colliding. Volatility isn't a side effect. It's the main event. Don't chase what already exploded. Manage risk like your future depends on it, because it does. Stay in the game long enough for the trend to pay you. Final question for you. Are you here for the metal or the leverage in miners? And if silver dips hard after the Fed, is that a gift or a warning? That answer tells me everything.